Buying a home, it's a huge step, full of possibility, right? But
Yeah.
let's face it, here in South Africa, financing, that's the big one. Usually means needing a home loan.
Yeah, absolutely.
So for this deep dive, we're cutting straight to it. South African home loans, what you really need to know.
Exactly. We've been looking at this in-depth guide, and, well, our mission here is to pull out the essentials for you. Doesn't matter if you're a first-timer, maybe a bit nervous, or, adding to your property portfolio. We want to make it clear.
Think of this as your shortcut. We're flagging the must-knows, potential pitfalls, those costs that
Hmm.
sometimes sneak up on you.
Hmm.
The goal is for you to feel confident, making smart choices, not like totally overwhelmed. Okay, let's dive in right at the start. What exactly is a home loan in South Africa? Simple terms.
Okay, so in essence, a home loan, people often call it a mortgage loan too. It's basically money you borrow,
Mm.
usually from a bank, right? And it's specifically to buy residential property, a
Yes.
place to live. It's a long-term thing, often 20, maybe even 30 years of monthly payments. And those payments, they include interest on the money borrowed.
Okay. And you hear home loan and mortgage used almost interchangeably. Is there actually a difference we should, get?
Yeah, it's a subtle point, but it's important.
Mm.
The home loan, that's the actual cash you're borrowing,
Got it. The money.
right? The mortgage bond, that's the legal bit. It's an agreement registered at the deeds office. That's the official government place tracking property ownership.
Okay.
And that agreement, the bond, gives the bank the right to, well, repossess the property if you default on the loan. If you can't pay, it's their security.
Ah, the safety net for the bank.
Exactly. And crucially, the bank usually only hands over the money to buy the property after that mortgage bond is officially registered.
Right, so the bond locks it all down legally. Now, I see this source mentions rules, regulations,
Mhm.
just making sure this is all, fair play.
That's a really good point. Home loans in SA operate under some pretty solid rules. The big one is the National Credit Act.
Okay.
That gives you rights like getting clear info about your loan,
Yeah.
and it protects you from unfair lending practices. Predatory lending, it's a big safeguard.
That's good to know.
And then there's a banking code of conduct, too.
Mm.
That sets standards for how banks should treat customers with things like home loans, ethical practices.
Okay, so there are protections. Good. Now, when you actually start looking at loans, wow, it feels like there's a whole menu. What are the main types we should know about?
Absolutely. And understanding these types, it could genuinely save you a lot of money down the line. The most common one is probably the variable interest rate home loan.
Variable. Got
So here, your interest rate isn't fixed. It moves up and down. It follows the prime lending rate, which the Reserve Bank sets. Our source says prime is currently 11.75% in 2025.
So if prime goes up, my payment goes up too. What's the good and bad of that?
Exactly. The upside is, if rates fall, your payments drop, which is nice, frees up cash.
Sure.
And sometimes the starting rate on a variable loan might be a bit lower than a fixed one, but the big downside is you don't know for sure what you'll pay month to month. If rates climb, your payments increase, and budgeting gets trickier.
Right. That uncertainty. That sounds like a major consideration, which naturally leads us to the fixed interest rate loan. How's that different?
Yeah, so with a fixed interest rate loan, you lock in your rate. For a set time, maybe 12 months, could be up to 60 months, 5 years.
Okay.
During that fixed period, your monthly repayment stays exactly the same. Doesn't matter what the prime rate does.
So the big win there is predictable budgeting. You know exactly what's going out.
That's the main draw, definitely. Makes planning much easier. The flip side, often the fixed rate they offer you at the start is a bit higher than the variable rate might be at that moment.
Ah, you pay for the certainty.
Kind of, yeah. And you could miss out on savings if interest rates happen to fall quite a bit while you're locked in. You're paying a sort of premium for that peace of mind.
Makes sense. Okay, then there's something called an access bond. That sounds flexible?
An access bond, yeah, it's got a really useful feature. It lets you take out extra money you paid into your bond above your normal monthly payment.
Oh, really?
Yeah, so if you've been paying a bit extra each month, that money isn't just like gone. You can actually access it again if you need to.
Okay, that could be seriously handy. Unexpected repairs, maybe renovations, anything to watch out for.
Well, the big plus is it almost works like a savings account tied to your bond.
Hmm.
If you're disciplined, pay extra regularly, only pull money out for real needs, it can cut down the total interest you pay quite a bit over the loan's life.
Right.
But you need that discipline. If you're dipping in all the time,
Yeah.
obviously you lose the interest saving perks, and it could even mean you pay off the loan slower.
Gotcha. Discipline is key. And lastly, the building loan. Sounds pretty self-explanatory, but what's the key difference there?
Yeah, a building loan is specifically if you're building a new house, not buying one that's already standing. The main difference is how you get the money.
Oh, so?
Instead of one big lump sum up front, the bank pays it out in stages.
Mm,
As the building work progresses, they'll usually do inspections at different milestones, check everything's on track, before releasing the next chunk of cash.
interesting. So they fund it phase by phase. Okay, let's switch gears slightly. Interest rates. They affect all these loans. We know they set our payments, but what actually influences the specific rate a bank offers me?
Right, several things come into play here. The prime lending rate, as we said, that's the baseline.
Mm-hmm.
Beyond that, your credit score is huge. A good score tells the bank you're less risky, you pay your debts.
Makes sense.
The loan-to-value ratio, that's how much you borrow, versus the property's total value that matters too. A lower ratio, meaning a bigger deposit from you, generally means less risk for them. And finally, your income stability and your employment history. They need to feel confident you can actually keep making those payments over time.
So, yeah, a solid financial picture is key. And our source mentions some people might get a concessionary rate. What's that?
That's basically when the bank gives you a slightly better rate, a lower interest rate, than their standard offer.
Why would they do that?
Usually because they see you as very low risk. Maybe you have an amazing credit score or a really big deposit or just a super stable financial situation. On the other hand, if they see you as higher risk, they might still approve the loan, but they'll charge a higher interest rate to kind of balance out that perceived risk.
Okay, so they're pricing the loan based on how risky they think you are. Got it. Now, how do they figure out how much we can actually afford to borrow? That's probably the first question for most people.
Yeah, critical question. Banks have specific ways they calculate affordability. They look at your gross monthly income before tax. Then they look at your regular expenses, your credit history again, and importantly, any other debt you're currently paying off. Car loans, store cards, that sort of thing. They need to be sure the home loan won't push you over the edge financially.
And is there, like, a rule of thumb? How much of my income should go to the bond?
A common guideline you hear is try not to spend more than about 30% of your gross monthly income on your total home loan repayment. But look, that's just a guideline.
Right.
What's truly affordable really depends on your specific life, your other bills, your lifestyle.
That 30% is a useful benchmark, though. Okay, let's drill down on some of those factors again. The credit score. Our source really hammered this home. Why is it so vital?
It really is. Your credit score, it's that three-digit number, right?
Mm-hmm.
In SIAC, it goes from 300 up to 850. It basically sums up how reliable you've been with credit in the past.
And a higher score means
A higher score shows you manage debt responsibly. And that translates directly into better interest rates on your home loan, like significantly better sometimes. And crucially, it massively increases the chance your loan gets approved at all.
what kind of score are we aiming for?
Our source suggests anything over 650 is generally seen as good, but to really get those top-tier competitive rates, you ideally want to be aiming for 700 or more. That jump, say, from 650 to over 700, even a small percentage difference on the rate, it adds up to huge savings over 20 or 30 years.
Wow. Okay, so it's not just about getting a loan, it's about getting a good loan. Where can people actually check their score here?
Good question. You can get your credit report from the main credit bureaus, places like TransUnion, Experian. And here's the thing. You're actually entitled to one free report from each of them every year.
Oh, free. Definitely worth doing then.
Absolutely no reason not to check it,
Okay, what about the debt-to-income ratio? How does that play in?
right? Your debt-to-income ratio, or DTI. It's pretty simple. It compares how much you pay towards all your debts each month, car, cards, loans, to your gross monthly income.
So if I have lots of other debt.
Exactly. If you've already got hefty monthly debt payments, the bank figures you have less spare cash available for a home loan payment. So basically, a lower debt-to-income ratio generally means you have more borrowing power.
Less debt equals more potential loan.
Mhm.
Simple enough. And the deposit. How much difference does the size of the down payment make?
Putting down a deposit, especially 10% or more of the purchase price, makes a big difference. It really improves your approval chances.
Why is that?
It shows the bank two things.
Mhm.
One, you can save. You're financially disciplined. Two, you have skin in the game. You're committed. Plus, a bigger deposit often means you borrow less relative to the property value, which lowers the bank's risk. And that can sometimes get you a slightly better interest rate, too.
So saving hard for that deposit really pays off. Now, if someone just wants a rough idea, like what ballpark figure could I maybe borrow? Our source mentioned affordability calculators. Where do we find those?
Yeah, they're super useful as a starting point. Most of the big banks and SA have them on their websites. Easy to find.
Okay.
And also, home loan originators companies like OBA, they're basically brokers who shop around for loans for you. They usually have really good user-friendly calculators on their sites too. You plug in your income, your expenses, and it gives you an estimate.
Definitely sounds like a good first move. Okay, we've talked about getting the loan, but what about before you even start looking seriously at houses? The source mentioned getting pre-qualified. What's the upside there?
Getting pre-qualified, yeah, it's a smart move. Big advantages. First, it gives you a competitive edge when you make an offer on a place. The seller knows you're serious. You've already started the financial checks.
Ah, makes you look like a stronger buyer.
Exactly. Second, and maybe more importantly for you, it gives you a clear budget. You know, realistically, how much you can afford before you fall in love with a place that's way out of reach. Saves time and potential heartache.
Good point. So how do you actually do it? Get pre-qualified?
Typically, you'd contact a home loan originator, like OBA East Coast was mentioned. You give them your financial details, income, expenses, debts.
Okay.
They'll then do a credit check and an affordability assessment. Based on that, they give you an estimate of what amount banks would likely lend you. The cool thing about using an originator is they often check with multiple banks for you at the same time.
Oh, so they shop around.
Yeah, potentially saving you legwork and maybe finding you a better deal than if you just went to your own bank.
Sounds efficient. Okay, let's shift gears to something less
Pivot.
positive but important. What happens if you hit financial trouble and you miss a home loan payment?
Yeah, this is serious stuff. Missing a bond payment. It's not something to take lightly. It can lead to penalties from the bank, extra charges. It can damage your credit score badly. They could take legal action. And in the worst case scenario, it can lead to foreclosure, which means the bank repossesses your home. You could lose it.
That's really serious. What's the advice if someone finds themselves in that difficult position?
The absolute #1 piece of advice: talk to your bank immediately. Don't wait. Don't bury your head in the sand.
Be proactive.
Yes.
Yeah.
Explain what's happening. Ask them what your options are. Maybe they can offer a loan restructure, change the terms slightly, or perhaps a temporary payment holiday where you pause payments for a short time. You could also look into debt review with a professional counselor.
So there might be options.
There often are, especially if you act early. The absolute worst thing you can do is ignore the problem and hope it goes away. It won't. Early communication is vital.
Crucial advice. Okay, now thinking about the costs. Beyond the deposit and the monthly payment itself, what are these hidden or additional costs that often catch people out?
Oh yeah, it's really important to budget for these. They can add up fast. You've got one-time costs when you buy.
Like what?
Well, the deposit, obviously, if you're paying one. Then there are bond registration fees, paying the lawyers to register that mortgage bond we talked about.
Right.
Transfer costs, which cover the legal work of transferring the property ownership to your name. And transfer duty, which is a government tax payable to SARS if the property value is over a certain threshold. The source at are 1.1 million currently.
Okay, tax on top.
Yeah. Then the conveyancer's fees. That's the attorney handling it all.
Mhm.
And even smaller things like postage and sundry fees. Little bits and pieces. When you get a quote from the lawyers, definitely ask for a full breakdown. Don't be shy.
Wow, okay. That's a lot just to get the keys.
No.
What about once you're in the house? Ongoing costs.
Yes, the monthly costs keep coming. You've got your main bond repayment, of course.
Mm-hmm.
But the bank will insist you have homeowner's insurance. That covers the structure against damage, like fire or flood. Yes. Usually required by the lender. Then you've got municipal rates and taxes. You pay those to local council for services. If you're in a complex or an estate, you'll likely pay levies for communal upkeep.
Right, for security or gardens.
Exactly. And the one everyone forgets, or maybe underestimates, maintenance and repairs. Geysers burst, roofs leak, things need painting. Owning a home means you're responsible for the upkeep, and that costs money.
So it's not just affording the bond payment, it's affording the whole package of homeownership.
Crucial point. Okay, so let's say we've done our homework, we've got pre-qualified, maybe we have a couple loan offers on the table. How do we choose the best one? What should we really be comparing?
Great question. Definitely don't just grab the first offer you get. You need to compare deals. Either get quotes from several banks yourself, or like we said, use a home loan originator to do that legwork for you.
And what are we comparing specifically? Key things. The interest rate, obviously. Is it fixed or variable? What's the actual percentage? Small differences matter hugely over time. Look at the loan term. Is it 20 years? 30 years? A shorter term means higher payments, but less interest overall.
Okay.
Check for any initiation fees or ongoing administration fees. Ask about flexibility. Can you make extra payments easily without penalties? Does it offer an access bond facility if that's something you want?
So really digging into the details, not just the main monthly number.
Exactly. Read the fine print, understand the terms fully before you sign anything.
Good advice. Now, there are always myths floating around, big financial things like this. What are some common home loan myths that are source busted?
Yeah, a few common ones came up. Myth number one, you absolutely need a 20% deposit.
Is that not true?
Not always. While a big deposit helps, the source points out some banks do offer 100% loans, meaning no deposit needed, especially sometimes for first-time buyers.
Okay, good to know. What else?
Myth 2. Bond originators cost you money.
And they don't.
Nope. Services like OBA, they're free for you, the buyer. The banks pay them a commission if your loan goes through them, so it doesn't cost you extra to use them.
That's a big one.
It is. And myth 3. Only banks give out home loans. Also not strictly true. There are private lenders out there, and building societies too, that might offer home finance. Worth looking into.
Really useful to clear those up. Now, specifically for first-time buyers, are there any extra perks or benefits in the South African market?
Yes, potentially. First-timers might be eligible for a government subsidy called the FELI-ESP program. That stands for Finance-Linked Individual Subsidy Program. And it can provide a significant financial boost if you meet the criteria.
FLISP. Okay, worth investigating.
Definitely. Also, some of the major banks might offer slightly lower deposit requirements for first-time buyers, or they might have specific loan products tailored for people new to the property market. Always worth asking what specific deals are available for first-timers.
Okay, good tips for those starting out. So, bringing this all together then, is taking out a home loan, the right move for everyone wanting to own property.
Look, a home loan can be a really effective way, often the only practical way for many people, to buy property in South Africa. It can be a path to building wealth, but it's a massive financial commitment. It absolutely requires careful planning, proper comparison shopping for the best deal, and honestly, probably getting some expert advice along the way. It's not a decision to jump into lightly.
Absolutely. Long-term commitment needs serious thought. And speaking of advice, the source had a bonus tip about working with professionals. Who should be on our team, ideally?
Yeah, building a good team helps massively. Firstly, a reputable estate agent you trust. They guide you through finding the right property and navigating the purchase process.
Makes sense.
We've already talked about the benefits of using a home loan originator. They simplify the loan hunting and application part.
Yeah.
And finally, it's really wise to consult with a bond attorney or conveyancer. They handle the legal documents, make sure everything's correct, and can explain the terms of your mortgage bond so you understand exactly what you're signing.
So agent, originator, attorney, a good support network. Okay, wrapping up our deep dive on SA home loans, what's the main thing you want our listeners to take away from all this?
I think the most critical takeaway is simply that knowledge is power here. Getting into homeownership, it really starts with understanding the landscape, knowing about loan types, rates, costs, your own borrowing power. It just empowers you. It helps you navigate what can be a complex process with more confidence and clarity.
Absolutely. That understanding really is the foundation for making good decisions, especially with something this big. So, on that note, here's a final thought for you listening. What's your next concrete step going to be in exploring your own homeownership journey? Will you actually go check your credit score this week? Maybe play around with an online affordability calculator? Or perhaps reach out to research a bond originator? Just consider how taking that one small informed step now, based on what we've discussed, could potentially save you a whole lot of time, money, and maybe even stress in the long run.